Welcome to Investing Lighthouse, where we explore the world of investing in the stock market. In today's video, we'll explore a topic that is often overlooked, but that is just as important, if not more important than knowing which stocks to buy. There are countless investment analysts making recommendations on which stocks to buy and up to what price. But how often do these same analysts recommend selling these stocks? And at what price should you plan your exit strategy? Knowing when to sell a stock can be a perplexing exercise because of all the questions that may cross your mind. Questions such as whether to only sell when the price declines so you limit your losses, or only sell if the price increases in order to lock in profits. What if the stock you purchased remains stagnant, while other investments thrive? Fortunately for us, Warren Buffett, the renowned investment guru, often referred to as the Oracle of Omaha, provided valuable insights on this matter. How to sell stock in the market has been a topic of great interest for the world's most accomplished investor. In this video, we'll explore 3 situations you may come across for which it may be advisable for you to sell your position in your stocks, according to the Sage of Securities. Our aim is to provide you with the finest tips from the world's best investors to help you attain financial freedom through your investment journey in the stock market. Before we explore the 3 situations that may prompt you to sell a stock, let's first understand why the questions posed in the introduction are misleading. They are all misleading questions because they revolve around what one would have paid for the stock, which is not an essential factor to consider when deciding to sell a stock. As Warren Buffett has pointed out, the stock market doesn't know or care about the price you paid for a stock. As an investor, you may have emotions and memories tied to a stock, such as who recommended it or the price you paid for it. However, these factors have no influence on the stock's performance. For example, if you bought a stock for $100 and it's currently trading at $50, you may feel terrible about your investment. But another person who purchased the same stock for $10 may feel great. Ultimately, emotions and past prices have no bearing on a stock's potential. So, if the stock's price movement should not determine your decision to sell it, what should? Now, here is the first reason that may prompt Warren Buffett to sell his stock holdings. Number 1. When a significant shift occurs in the economic characteristics of a business. Warren Buffett's approach to selling a stock is quite straightforward. He believes that it's not wise to sell unless there are significant changes in the economic traits of the business, and if he becomes disheartened with the management team. So, if you're looking to invest like Buffett, keep an eye on the economic features of the business and the performance of its management before making any selling decisions. Now, let's take a closer look at some real-world examples of major changes that prompted Warren Buffett to sell his stock holdings recently. In 2020, he sold all his stakes in major airline companies, stating that the COVID-19 pandemic has fundamentally altered the airline industry. Similarly, in 2014, he sold his share of the Washington Post, one of his most significant investments of all time, citing the drastic changes in the newspaper industry and the Post's declining competitive advantages compared to when he initiated his position back in 1973. Another example is Buffett's investment in Tesco, the British multinational grocery chain, which he sold due to an issue with its management team. Although the exact reasons for the sale remain unknown, he completely divested his holdings in the company by 2014, incurring a minor net loss. Let's say you invested in a company that produces DVDs and Blu-ray discs. However, with the rise of streaming services like Netflix and Hulu, physical media sales have been on a steady decline. The company's financial reports also show a significant decrease in revenues and profits over the last few years. If you believe that this trend is unlikely to change and that the company's growth prospects have changed in a major way, it might be time to consider selling your stock in the company. As Warren Buffett says, our inclination is not to sell things unless we get really discouraged, perhaps with the management, or we think the economic characteristics of the business changed in a big way. Let's move on to the second reason why Buffett would consider selling a stock. Number 2, consider selling when a superior investment opportunity arises. According to Warren Buffett, if a superior investment opportunity presents itself, he would usually sell his current holdings to pursue it. He once shared that for the first 20 years or so of his investing careers, he sold stocks not because of a decline in the performance, but because he found something else that he was eager to invest in. This highlights the concept of opportunity cost. When you allocate your funds in one investment, it means you're missing out on the other potential investments. This can be a challenging decision, however, especially if you have a fondness for the company you're currently invested in. But sometimes you have to let go of good investments to pursue something that you feel promises more. In 1959, Buffett Partnership Limited sold his holdings in a bank called Commonwealth Trust to invest in the mapping business of Sanborn maps. In his letter to partners, Buffett explained the decision by saying, "We found a special opportunity to become the largest shareholder of Sanborn maps at an attractive price, so we sold our block of Commonwealth and obtained $80 per share." He also noted that the buyer of the stock at $80 was likely to do well over time, but the relative undervaluation of Commonwealth at $80 with an intrinsic value of $135 was different from that of a stock at $50 with an intrinsic value of $125. In other words, Buffett believed that his capital could be better utilized in a situation that replaced it. While it's often cited that Buffett's favorite holding period is forever, it's important to understand that this is more of a personal preference, based on his desire to build strong relationships with the managers of Berkshire Hathaway subsidiaries. Rather than solely focusing on maximizing returns, Buffett prioritizes the long-term value that these personal connections bring to his business. Buffett has made it clear that he prioritizes his personal relationships with the managers of the subsidiaries at Berkshire Hathaway over the potential to make a few extra percentage points of returns. In fact, he has compared selling a subsidiary to selling one of his own children and has vowed to never do so. He wants his partners to understand that his loyalty to these relationships goes beyond mere financial gain. Buffett's attitude towards holding businesses for the long term began to shift after a negative experience with Dempster Mill Manufacturing in the early 1960s. The town where the company was based was angered by the job cuts and cost reduction efforts that Buffett made to turn the company around for a sale. Perhaps a better advice for smaller investors can be found in his 1961 partnership letter. When he operated with less capital, focus on buying undervalued securities and selling them when the undervaluation is corrected. Finally, there is another situation where Warren Buffett would consider selling a stock. Number 3, when a single stock holding gets too large. When it comes to portfolio diversification, the common saying of not putting all your eggs in one basket still holds true. However, don't be too rigid about it. If you have a smaller portfolio and the proper risk tolerance, you could consider having a larger position in a single stock. As an example, Warren Buffett invested 40% of his partnership's funds in American Express in 1967 when he was managing over $500 million in today's equivalent. Although the stock eventually exceeded his 40% limit, he only reduced his position to maintain some level of diversification. To wrap things up, selling a stock should have nothing to do with the price at which you purchased it, since the stock's future performance is indifferent to the price you paid for it. Ask yourself if you would choose to invest in a particular stock if you didn't already own it. If the answer is no, it may be time to sell your position. It's also important to recognize that the decision to hold onto a stock and the decision to buy more shares are not identical, although they are connected. In addition, selling a stock to reinvest in another option can lead to tax obligations and transaction fees. So it's important to weigh the potential benefits against these costs. Holding on to your stocks is also an advisable strategy if you are not willing to increase your stake in a company but yet see no compelling reason for you to sell your position. This is often overlooked in today's investing world but can be crucial for successful investing. On the other hand, if a better investment opportunity arises, if there is a fundamental change with the company's prospect, or if a single stock becomes too big, it may be wise to consider selling. You now know when to sell a stock, and we really hope you found the information helpful and informative. If you have any questions or comments about the topic we discussed, please leave them in the comments section below. We always love to hear from our viewers, and we appreciate your feedback. If you've enjoyed the video and found it helpful, please hit the thumbs up button, subscribe, and hit the notification bell so you never miss out on more financial tips and insights. Thanks again for watching, and we'll see you in the next video.